I think we got to just start with the Fed rate decision coming up this afternoon. Do you guys share the consensus opinion of a 25 basis point hike? And do you believe that no talk of a pause or a pivot is already priced into the market, or is the market, do you still believe there might be a pause or a pivot? Phil, you first, please.
Okay, so I'm in the camp where the Fed knows that he's in the red zone, which is a great thing, but investors believe that he's in the end zone spiking the football, and that's the problem that I have, and that's the major disconnect. Investors are acting like he announced quantitative easing in the beginning of January, looking at Bitcoin and high beta stocks flying high like we're seeing today. But the problem is the Fed and his colleagues continue to tell us the same thing, that they're going to continue to push along until they get what they get, and we're just not there yet. And because of that, this is nothing more than a bear market rally.
Beth Ann, you share that opinion?
On my end, I'm looking for pretty much similar to what Phil had said. I'm expecting a 25 basis point rate hike today. I don't think they're finished just yet. I think they're going to go to 5.25. I don't think the markets have priced that in, and I think the markets are acting a bit more sanguine than the Fed would like them to be. In our mind, the Fed seems to say that they're going to get up to that exit rate and stay there for some time, where markets are already pricing in a rate hike later this year. I don't think that's in the offing at this point in time.
So Beth Ann, while you're talking right now, we're showing some of the results of our Fed survey. One question I want to ask you about is, what's your thoughts about a possible recession, Beth Ann? Are we inching closer to it with this rate hike without any talk of a pause or a pivot? Or has that sentiment changed because we continue to see relatively strong consumer spending? And, you know, the job market's obviously, very tight. We're not seeing those economic indicators of a possible recession right now.
Well, what we're looking at in our forecast, we do see a very shallow recession in 2023. Indeed, our indicators are suggesting as much. However, one of the reasons why we think it's going to be a shallow recession is partly the resilience in the U.S. economy and the private sector. Both households and businesses have basically shored up their holdings in terms of cash and savings, and that's giving them wherewithal to continue to spend. That said, I do think that the cumulative rate hikes that the Fed is pushing onto that cure, which is more painful than the disease at this point, will eventually push the U.S. into recession. We're already starting to see people start to say, search for value, trade down for cheaper earnings, cheaper things, and we already saw some weakness in retail sales in December. We think that'll continue into the year.
So, Phil, do you share that opinion that we're on the brink of at least a mild recession? And if we are on the brink of a possible recession, even if we're not, what stocks are you looking at right now as the best play right now today?
So this whole talk about a recession is really getting challenging, right? So if you think about everything that the Fed has done today, everybody would have thought, and looking at all the indicators and the regular playbook that we're all used to, we would have thought today we'd be in a recession, if not over the next quarter or two. The problem is that when you have a tight labor market like we have, consumers have money to spend. If consumers have money to spend, it's very difficult to go into a recession. And I think that is the other disconnect about what's going on. Listen, if we have a recession, then that means markets will get cheaper. And me as a long-term investor for my clients, that's an opportunity to buy stocks of great businesses on the cheap. What I like specifically today is I think Google really has come in at a great price point, a forward multiple of 18, growing more than the S&P. That's where the S&P 500 is right now. The free cash flow yield is one of the most attractive yields for Google I've seen in a very long time. Return on investment capital is very strong. We know it's down because of advertising spend, and that may continue in the short term. But as a long-term investor stepping in on Google, I like that very much. Also, Nike. I think Nike on a reopening trade of China. Nike also has a pretty good free cash flow yield for that company. Return on investment capital is fantastic. Right now, it's trading below fair market value for us, about 15 to 20%. So I like Nike on a reopening China trade as well.
So I want to ask both of you this, and Beth Ann, if you don't mind answering first. The Fed seems committed to getting inflation down to 2%. We're a ways away. It's about 5% away from where we are right now. As they continue to at least try to battle inflation, what do you think that Jerome Powell can say today that will give the markets some comfort? We know, obviously, a decision at 2 o'clock, but after that, what can he say that give people the confidence to put their money to work back in equities?
I think that the Fed's job right now is to basically stable and stabilized prices. The jobs market is incredibly tight. And I would go back to that point about the jobs market. Indeed, the job market is incredibly tight. That is providing the resilience for the U.S. economy. However, that's also causing a problem for the Fed. When you look at wage gains, which now, I guess in December, they were at 4.6% in December. Maybe they'll stay about that. Maybe they'll go a little bit lower. That is it, but that is double what the historic rate is for average wage gains on a year-over-year basis. A big problem for the Fed, particularly since inflation is outpacing those prices. And so that's a concern for the Fed. I think what the Fed's going to say is that, well, we're going to stick for the long haul. And I think what they're, unfortunately, it might not be a comfort for the markets, but I think Chair Powell is going to say that we plan to get to the exit rate and stay there for some time. That seems to be where the disconnect is between markets and the Fed.
Phil, I'm going to give you last word. We got to get going. But is there anything that Jay Powell can say?
Listen, the Powell wants the market to go lower because the wealth effect to dry up demand. And that's what the Fed needs. Between the job labor market creating demand and the stock market performing the way it is, that doesn't help the Fed's overall motivation and goal of bringing inflation down to 2%. But ultimately, this is healthy for the economy, getting back to normalization. The Fed fund rate should be at 4.5 to 5.25, right? Because if we go into a difficult period with the economy, then the Fed has room now to bring rates down. So, this is welcoming everything the Fed is doing. And this is the point that I think everybody is missing.